Hello ladies and gentlemen, welcome to today's webinar. I'm Joseph Novichkov, Senior Trading Manager with GDM. Today's session, ladies and gentlemen, is the time when we will take a look at another simple way to find out whether the market is ranging or is actually trending. The simple concept of finding market direction will not, of course, provide us ultimately with trading opportunities like entry signals, exit signals, so on and so forth. However, it is very important to our trading plan to have a market direction in order to place our positions in a correct way with, of course, the appropriate lot size, the appropriate stops, targets, so on and so forth. The first tool of today's session, we have already took a look at it. It is the average true range. We saw it on last Wednesday's webinar. Briefly, I will one more time cover the simplicity and, of course, what it actually measures of this tool. One more time for those that are coming here for the first time, that actually missed the previous webinars and have not had the chance to review the recordings of this particular webinar, which involved the average true range. First of all, let's have a look at the chart. We are going to set the oscillator, which is the average true range, on a euro-dollar 1 hour chart. Why do we focus on a 1 hour chart? Later on, I will explain further with more details. But first, we need to set our average true range oscillator with the same period, which was the last time, period of 14, which measures, of course, one more time, the volatility for the past 14 sessions, or, as we mentioned, the past 14 hours in this case. As you can see, from the average true range, only with the average true range, is very difficult to find out any direction or particular signals. The only thing we can see is the amount of volatility at this stage. Obviously, speaking in terms of small time frames, usually the volatility is much higher than larger time frames. So let's take a look at the daily chart. As you can see, the volatility is a bit more choppy, and the period of the 14 ATR is actually not enough to measure volatility on larger time frames. Therefore, we have to filter out those volatility spikes, and in that case, we cannot really use it on larger time frames. Therefore, 1 hour chart seems to be much better, especially with the connection of the other tool that we're going to use. But before that, let's see why the average true range is so important to use it along with the rest of the tools that we're going to talk about today. It is often suggested that when using the average true range, this, of course, can actually prevent us from experiencing bad trades on the market. Like, for example, if we're on the wrong side of the market, we can be subjected to gaps or limited moves, which in both cases are caused from volatility standpoint. Therefore, the ATR gives us a better look at what the volatility is at the current stages. So the more the market is starting to trend and to cause rapid moves one after another, session after session, we can see that the ATR is growing in volatility. As far as we're concerned, when the volatility of a particular trend gets to a certain point, which is pretty much the middle of the ATR, we can expect further down moves. Therefore, for those that are interested in setting such midpoint between 0.004 and 0.008, we can see that the midpoint should be somewhere around this level here, 0.020, 430. I would suggest pretty much we can say that this could be our mid-range. And of course, we can set this by entering the levels of our ATR and just set a new level of, let's say, something like this, and give us a clear point where exactly would be the turning point of the trend if we are only using the ATR. However, the measurement of the ATR is a concept of the true range. The true range is the absolute value which is used to ensure positive numbers, always positive numbers. We don't have negative volatility. That's close to impossible. After all, in measuring the distance between 2 points, not the direction. So you see, we cannot really spot any market direction with the ATR. However, with a combination of another tool that it's called Standard Deviation, we can expect to see numbers again, which of course in this case will tell us a bit more about direction rather than the ATR itself. You can find this in trend, obviously, because it's another volatility tool, but it's mostly used for measuring direction. Let's try to imply one more time, but first of all, what I need to see here is the ATR itself with the standard deviation, ladies and gentlemen, one on top of another. So therefore, we'll just grab it here from our navigator bar and drag it on over the ATR. Set the same period of 14 with, of course, the style. We can always set it by our preferences, and here we can go and set it over the ATR, and this is how it looks. We can expand a little bit more so we can see better the ranges, the crossovers of these two tools, and of course in the future spot market direction. How to do that will closely follow after I make a brief introduction to the standard deviation tool, basically because we have never used it before in our webinars. This is the first time, and for those that are not familiar with the trend tool called standard deviation, now they will find out what it measures, what it's calculating, and how we can use it to predict directions. Standard deviation, ladies and gentlemen, is a statistical term basically that measures the amount of variance or, of course, dispersion around a moving average. Standard deviation is also a measurement of volatility. Generally, dispersion is the difference between the actual value and the average value. So see here what we mean by the difference between the two tools and the combination that makes a powerful trading suggestions of market direction. So one more time. The dispersion, as we mentioned, is by far the difference between the actual value, which is the standard deviation, and the average value, which in this case we take from the average true range. the larger this particular dispersion of variability is, the higher the standard deviation is. The smaller the dispersion or variability is, the lower the standard deviation. So what do we mean by standard deviation? It's this tool particularly can be used by technical traders to measure an expectation of any kind of risk and determine the significance of particular price movement. So it is very simple how the calculation is being made within this tool. I'll briefly mention it, simply because this is something that is for those that simply to inform what it measures, how it measures. But first of all, we have a moving average or a standard deviation line, which tells us exactly at the point of time the price that it's measured by the past 14 sessions, gives us a level that we can use to, of course, suggest the value of the standard deviation. As you can see, value of 0.0002. This is a very low particular volatility. You can see the ranges between these and these points are very, very small. So for those, one more time, that wants to use these particular tools separated, so you don't have to point every time where the price is and what the numbers are, you can still use the standard deviation as a separate tool and still check the numbers at this stage, which are like this. So this is just a suggestion here, the combination of the two of these. But first of all, using them one on top of another is another trick that I could implement in any trading plan. And of course, I'm using less space on my chart to see whether the standard deviation is larger or smaller in numbers than the ATR. So let's just put it back in again, but it will go just going to see those two, but one on top of another. So let's put it back on. The application is to the previous indicators data. Of course, it's not going to work like this because the previous was the standard deviation itself. So we're going to place it on the ATR by removing this one. There's some kind of glitch here. So we're just going to do this one more time. As you can see, the standard deviation stands alone when we get rid of the ATR. So we're just going to cover this one more time like this. Put this one on. Set the standard deviation on top of it. Select the previous indicators data. And it doesn't work every time, but that's quite all right. I'm just going to do it again. Sorry that I have to put you through this, but still. Just bear with me for a second. There it is, one on top of another. Now, getting back to the calculations of the standard deviations, the standard deviation, ladies and gentlemen, it's with just a few simple steps. It calculates the average price for the number of periods that we're observing. In this case, period of 14. It determines each period's deviation, which means close, which is less than the average price. It squares each period's deviation as well, and it sums the squared deviations together, dividing this particular sum by the numbers of the observed period, which of course reflects on the standard deviation that equals to the square root of the number. Now this, ladies and gentlemen, might not mean much to you, but this is a simple formula, as I mentioned earlier, that is implemented into the standard deviation to give you this green line that you see on your screens. The values of the standard deviation are dependent on the price of the particular instrument that you're trading, in this case the euro dollar. However, the larger the price is, the higher the standard deviation values can be, with low prices of the particular instrument that we're trading. So these higher values are not reflection of higher volatility, but rather a reflection of the actual price itself. The value of the standard deviations are shown in terms that of course relate directly to the price of the underlying instrument that we're actually trading. So in this case, this is the US dollar. Now, the measurement of the standard deviation is an expectation, ladies and gentlemen, which means the current value of that standard deviation can be used to estimate the importance of a move or set an expectation in the future, which is what we actually need. This assumes, of course, that price changes are normally distributed with the classic curve, as we can see it here, like this classic curve. You can see a lot of them, but with low volatility and low price movement for the past 14 periods, obviously averaged, will give you a smaller curve like a bell or something like that, you see. Now, even though price changes for the instruments that we're trading are not always normally distributed, we can still use normal distribution guidelines to gauge us about the significance of a price movement. In a normal distribution, now here this is very important, 68 to 70% of the observations fall within one standard deviation. 95% of this particular observation falls within two standard deviations, and 97.7% of the almost close to 100% of the observations fall within three standard deviations. Using these guidelines, ladies and gentlemen, traders can estimate the significance of a price movement. A move greater than one standard deviation would show above the average strength or weakness, depending on the direction of the move. So when we're using the standard deviation with the ATR, these two values at the current price can tell us whether the market is ranging or trending in these stages. So when we talk about 1 hour chart, it is very important to notice that the measurement of the current price position of the standard deviation and the ATR are averaged by the past 14 periods, which means with the next few hours or few sessions, or the next 14 sessions, let's say, the direction is going to be kept the same. This means that this anticipated move, or these expectations as we spoke earlier, suggests us about the direction. A combination with another tool with the standard deviation and the ATR will give us a better statistical measure of the volatility, and these values would provide us with an estimate for expected price movements. Now price moves greater than the standard deviation, which are, let's say, higher than the higher level here, could give us an indication of how long this move will end, will continue, where it's going to end, closer to the extremums, and from where we can expect fall in volatility for another one to pick up somewhere in this stage. And as you can see, with a conformational candlestick here, we have about close to 60 pips in direction in this case. In about 6 sessions or, 5 sessions or 5 hours, this is enough for us to make our profits. However, how to closely monitor these price suggestions and directions, we're going to use another tool, which is not a must in this case, don't get me wrong. I usually use it in combination of this particular system to suggest further movements, a little bit more assurance of the direction. We can use Bollinger Bands with a deviation, standard deviation between from above and below the moving average from what we want to capture. Basically, we want to capture the price movement. This means, as we mentioned earlier, let me refrain to that one more time. The normal distribution, 68% to 70% of the cases or the observations of price hikes and movements are less into about 21 cases. Now, speaking of which, further standard deviation, as we mentioned, 68% of the observations are falling within a standard deviation of 1. Let me show you. Standard deviation of 1. Let's see how it looks. You see how the price is getting out of these bands. Let's zoom a bit more so you can guys see it better. So these bands above and below the moving average gives us an overview of 68% to 70% of the cases when the price stays within the range of these bands. Everything else falls out of this range, out of this deviation. 90% of the observations or the cases fall under 2 standard deviations, like this. You can see how the deviation is now expanded. And normally, if we want to capture about close to 100% of the cases, which that's close to impossible, 99.7% of the cases fall within a standard deviation of 3, which gives us a bit larger range to trade. However, getting into these conditions of standard deviations of 3 on the Bollinger Bands, ladies and gentlemen, will get us a little bit into trouble, especially when it comes to using these 3 tools together. So if I want to use the Bollinger Bands with these ATR and the SD, that would mean that I have to limit myself to at least standard deviation of 2, basically because I want to fall within these 95% of the cases, because I want to take that profit a little bit earlier just to be sure that the price is not going to, let me get back to standard deviation of 3 so we can take a look of exactly what I mean. is that in some case like this one, the price is not going to touch the lower bound of the Bollingers, and in this condition it's going to retrace more. So if I'm taking this particular move here, let's say this is 100 and a little bit over 110 pips, let's say, but the price didn't really touch the Bollinger Bands here. It touched it here, so this is another exit that we can make. But this also in this case is pretty much the same retracement, which is nearly 30 to 40% of the price movement. The price declined in this case. So I want to take that profit as well. Whether it's going to be partially or at one time, I want to be sure that I exit a little bit earlier so I can take as much as the profit as possible. Therefore, if I'm entering here, my first profit will be somewhere here, 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 and here. So you see, a partial cash in of our profits is much better than actually risking all in. And here in this case, using the Bollinger Bands, first of all, it's been ranging for some time, and then it breaks off with a large candlestick, which suggests further downside movement. In this case, one thing is important to notice, that traders using the above chart without the SD and the ATR will limit their movements and their trading from here to somewhere here. So that's about 70% of the profit that we're actually able to take. But using the ATR and the SD all together with period of 14, this will give us much more clarity of where we can enter the market and where the directional movement starts, because we need to know whether the market is ranging or not. Now, let's have a look at how to use all this together. First of all, it's something that mostly works well when in terms of 1 hour chart time frame, because of the periods that we're using on this chart. 14 period for the moving average of the Bollinger Bands, 14 period for the standard deviation, 14 period for the average true range, and at this time frame, with these two indicators, we have to now monitor the values. But instead of looking at these numbers here and the middle point, as we mentioned here, you know, because our profits are not going to be dependable on the SD and the ATR rather than the Bollinger Bands and support and resistance levels. If, of course, you have another preference of taking profits by using the commodity channel index, or also measures volatility, or anything else that measures volatility and gives us overbought and oversold conditions like the relative strength in the stochastic, this is also a good idea. However, if our ATR, which is the blue, is in this case, as we can see here, larger in value than our standard deviation, that means that in this case the market is ranging. As you can see, after this crossover here, you know, we're going to track back a little bit later to see in the past performance, we have a larger value of the ATR and a smaller value of the average of the standard deviation, sorry. But after this range has been completed, with another crossover here giving us a higher value of the standard deviation and a lower value of the average true range, now we know that the case is quite the opposite, and our expectations are for markets that are trending. So here we see a trending market. The logical, of course, explanation of this simple system is that if the standard deviation is smaller than the average true range, it means that the ranging market is at hand for the past 14 sessions. And of course, this is because our average true range measures the range of the high and the low. So the range between here and here, you can see that higher levels of the ATR are seen every time the market is ranging. But every time the market is breaking off of this range, lower values of the ATR are at hand, and our standard deviation is expanding higher, as well as our standard deviation of the Bollinger Bands are also expanding further. So this dispersion between the bands are represented by the standard deviation that we're using as a signal to a trending market. So in this case, you can see the lowest value of the ATR and the larger in value standard deviation gives us a prior heads up to the next market move. And of course, both of these, after all, are volatility indicators. One thing is absolutely certain here is that the larger in value standard deviation is at this stage, the longer the trend will continue. When these values begin to switch sides, the standard deviation becomes smaller than the ATR, it is time to conclude our profits, cash them in, and wait for the other trend. But of course, for those that are interested in combining all this with tools that are good to trade ranging market, and you're interested in all possible market situations, you can use these tools to signal when the market is ranging and start using, let's say, RSI, stochastic indicator oscillator, also to give you a good opportunities on the market. Now, while we're at it, let's just add a simple RSI. I suppose it was here. Yes, there it is. Period of 14. Now, let's have a look at this point. We see that as long as the trend is alive, the RSI dipped below the extremums here remains for the time being. When the market starts ranging one more time, the RSI goes within that range and starts hovering between these extremums. Let's skip a little bit backwards and take a look at this these ranging markers here. You see a very well sustained range. The RSI is hovering between the ranges. You can use it to trade. The values also you need to follow to pick a market direction into that particular range. And of course, when you skip further back, we can see the same case here within this slowing trend. Ladies and gentlemen, these simple moves that we take on the market and gives us an opportunity to learn something new, we can always get bits and pieces, put them together, and just draw the big picture of this particular puzzle. Everyone can take a piece here from a piece there and put all together a very good strategy that works for him or for her, for the trader at hand. So use whatever is necessary. If you need an additional assistance to help you, develop a trading plan or a trading system by your preferences, your time availability, your understanding about the market, and of course the size of your investment, we can help you do that. This system today, ladies and gentlemen, using the standard deviation in the ATR along with the Bollinger Bands are just market direction suggestions and expectations. This is not giving you entry points. Your entry levels could be taken from a different strategy, like let's say you can take the ADX or the parabolic to give you also market directions and entries when the market starts turning around. Also to confirm by the SD and the ATR, giving you further assurance that the market direction is down, or I mean whether the market is trending or ranging. So basically, in this case, you don't know whether the direction is up or down in this trend, but you know that the market is trending. And it's obvious in this very small case here that it's downtrend, because the Bollinger Bands are expanding the other way around. The first lower band is ultimately declining. This one is a bit slower, which is the higher here. So the values of the standard deviation and the ATR can give you a very good idea whether the market is ranging or the market is trending. Use this technique, and if you have any questions or any other ideas that can help us, of course, expand our webinars from any point, feel free to suggest. You know how to find us. Go to our website. Over there you will find our chat on the support department. We have the telephone numbers directly to our office. You can always request an attention from an account manager or senior trading manager such as myself. We can always get in a one-on-one session and get it going. That's all for today. Thank you very much, ladies and gentlemen, for being today here with us on the last webinar of this month. I expect, of course, the next webinars to start in March. You will find the registry pages strictly on our website when we're ready to deploy, and of course you will receive a confirmational email, so on and so forth. Until then, thank you for joining us. It was a pleasure for me one more time. See you next month. Thank you. Bye-bye.